Morning, Chris. How you doing?
Good morning, my friend. I'm excellent. How are you? You're looking good.
Thank you. Thank you. This is Brian Jones. I'm here with Chris Hood, professional options trader, world's most interesting man. How's
World's coldest, man, today.
how's
-8.
the Great
Oh,
White North up there in the Canadian wilderness?
man, I tell you, I got foxed. I honestly got foxed. When they told me to come to Canada, it's a great place. I said, where do Canadians go on holiday? And they said, Mexico. I was like, well, it can't be that far. It must be
Yeah.
the same weather, you know?
So,
Should have checked the damn
what's the
atlas.
what's it doing up there now?
What's that?
Are you still getting snow?
Oh yeah, we got about 8 feet. I've got a snowbank on my driveway on the one side that's about 6 feet high and about 5 feet deep. And then every morning the snowplow comes past, and because my neighbor shoves all their driveway snow into the road, the snowplow pushes all their snow into my driveway. So this morning at 4:45, I was up at -15, dressed like an Eskimo kind of thing, shoveling snow so my wife could get my son to school on time. And I had these big chunks of ice. It was like icebergs in my driveway. It was crazy.
That is
You
nuts.
get used to it, I suppose.
Winter is, I mean, I like snow, but it's irritating sometimes when you have to do normal things. It just gets in the way.
It's hard, like the thing that you've got to worry about is that in an emergency, if your driveway is, covered in snow, like what are you going to do? And there's been cases before of ambulance crews and fire crews not being able to get to the house because there's too much snow and all of that. There's a lot of things. So you've got to keep your driveway clear so that you can at least get out. But we've only had to shovel 4 times this year, which is more than last year. Last year we didn't have to shovel much.
Nice.
But the snowstorm we had a couple of days ago was the biggest snowstorm they've had in this area for 25 years.
Well, congratulations.
I lost my car. I couldn't find my car. I mean, thank God for the little side mirrors, because otherwise I thought my car was gone. My whole car was covered up to the roof. So it took us 3 hours. Thank goodness for children.
That's too much snow for me.
Well, I just used my 9-year-old. I was like, listen, do you want an inheritance? He's like, yes. I was like, well, dig the car up, buddy. So I had to give him an extra $10 on his inheritance, helping out the old man with the car.
So, Chris, what's the deal here with the market? When are we going to hit this bottom? This is getting a little bit ridiculous.
Well, look, the thing is, yesterday was, for me, one of the weirdest days I've ever seen in the market. In the morning, you would have thought that everyone was going to be taken out to the back and shot. And by the afternoon, all had been forgiven and they'd been promoted. It was crazy. That lunchtime reversal, I haven't seen something like that in a long time. The sell-off in the morning was pretty brutal. The selling over the last couple of days has been fairly severe. And yesterday we hit, I wouldn't call it some records to be shouting about, but we hit the same level of declines as we had at COVID. So, it was bad, and then all of a sudden you had the market actually come back. And that was surprising. That was very, very surprising to see it come back that strong. But, like I've said before.
Positive news though, like for...
I don't think it's as much positive news. I think it's a matter of people really looking for opportunities. If you look at where the S&P was, it was underneath the 200-day moving average. Mm-hmm. And remember, the 200-day moving average is a critical level of institutional support. So when things get there, the retail guys have all gone, right? Let's just imagine that the retail guys have packed up their picnics and they've left. Those are the big guys with the money that can move the market. Those are the guys who play at that level. So when we start seeing some buying going on there, it's not retail that is doing it. Retail's left. They left the building at the 34. I think that the institutions are all coming in and they're saying, you know what, Jerome Powell has to do something. He has to either put some clarity into the market, because there's a little bit of an indecision or a little bit of uncertainty as to how fast the Fed's going to raise rates. And tomorrow, if he comes out and says, this is what we're going to do, we're going to put up 0.25% here, 0.1% there, whatever it is, whatever the plan might be, there'll be certainty. The market hates uncertainty. So that's what they're looking for. And yesterday's rally was almost like, you know what? I think he's going to do something positive, right? Some sort of dovish comments are going to go a long way tomorrow. Looking at the charts this morning, oh man, there's going to be a lot of blood on the street this morning, which is great. I mean, look, as an options trader, I love it. I don't care which way the market goes. You should be able to make money in both directions. Doesn't really matter. And unfortunately, that kind of mindset, the trading in both directions, is not common amongst traders. Okay, retail traders. I'm talking about beginners, guys that have only traded in the last maybe 2-3 years. The reason being is they've never been in an environment where interest rates rise. So for them, it's just been a permanent bull market, buy the dip. And, every time it pulls back to this moving average, we're going to do this. And then it becomes so monotonous and it becomes so dangerous because they start thinking that situation, that scenario is never going to change. And now it's changed. So I think yesterday was a little bit of margin call Monday in the morning, a little bit. There definitely was a feeling that the activity from Tuesday and Wednesday of last week certainly may have put some brokers under pressure, particularly if their retail clients have been using leverage to, sell puts on the dip kind of thing, right? And then they got whacked. Now they've got to fix those accounts up and they were just starting to liquidate.
You mentioned
there was a feeling.
Potential, potential hedge funds maybe have gone under. Do you know anything about anything like that?
Yeah, I actually had a feeling. I haven't heard anything for sure. The only thing that I could look at was the patterns, right? So when we look at the data from Friday and we look at the patterns of selling, the extreme readings that we were getting were very, very similar to what we saw when funds get liquidated. So there was an element of that. There was definitely some rumor. I mean, we don't know. I'm not connected in there. I mean, who knows? We won't know for a while anyway. But there was definitely a feeling that there was someone getting liquidated. Definitely. But when it comes to, margin Mondays, you always have to look at the activity on the Tuesday and the Wednesday before the Monday. And if you look at Tuesday of last week, it was horrible. Tuesday and Wednesday last week were terrible days. So it's inevitable. You're going to get a bad Monday after a bad Tuesday, Wednesday. So things to always be aware of. If you have a bad Tuesday, Wednesday, likelihood of a bad Monday is definitely there. So yesterday was very surprising. Terrible morning, phenomenal afternoon. It took me by surprise. I was ready to go downstairs and watch a Netflix series. And, all of a sudden at 1:30, I thought everyone was at lunch. Things just reversed. It was, gone was my series that I wanted to watch. And I had to do some damn work. So it was quite strange.
There's a fairly significant down opening this morning. It looks like it's gonna.
There is, but there's some signs of momentum on the much smaller time frames. I'm just looking at some charts here. There's some good momentum in the hourly and under on the Qs and on the hourly under on the SPY. Some of the stocks, Nvidia is looking like it will probably bounce at, dip at the morning and then, or dip at the open and then come back up. Apple, yep. I think that we'll probably land up having one of those days like yesterday, deep sell in the morning, everyone getting fearful and then buying into the afternoon in preparation for tomorrow. If you're day trading, it's probably a good idea not to have any positions going into tomorrow. Mm-hmm. If you're looking to do swing trading, no, I'd wait till Thursday, Friday before I do anything that's sort of longer duration or initiating new positions. I've still got a couple of positions that are long dated. They look a little weak, but they're not sized huge. So for me, I can tolerate it. A lot of guys make that mistake when they buy the dip of oversizing the position. And then it goes against them and they go, oh, crap. Now what do I do? And that's the mental game in trading is you've got to make sure that biases aren't influencing you negatively. And unfortunately, a lot of people have a bullish bias. And when you have a bullish bias, your strategies become limited. You should really trade with neutrality. It shouldn't matter to you what direction the market goes. You should be able to trade in two directions and make money in both directions as an effective trader, right?
So do you
as far as swing trading goes and strategy, just avoid doing anything where your risk is going to be up. You're skewing the risk more towards the market. So your risk reward should be I'm risking 100 to make 900. I mean, we did those call butterflies and those put butterflies from Friday for yesterday. We lost on 2 and we nailed 1. And the profit that we made on the 1 paid us off for all the ones that we missed and gave us a gain. So, that was I think it was a 9x that we did on the SPX. And that's the way you got to trade. You've got to be willing to do those kinds of trades where we were risking $100 odd on a trade to make 1,000, and we nailed it. So that's the way that we do it.
So do you think that it's best for new traders to kind of learn one directional trading and then kind of move into the other direction, like work with the bullish trades first and then go into short trading?
The first thing that I would suggest people learn is how to read a chart. So once you understand how to read a chart, and once you understand how to, leverage your indicators, whatever those indicators might be, doesn't matter what you're using, but you've got to understand them. Once you understand them, you can trade direction. Reading a chart will give you the direction. Then you pick the strategy, because the strategies, if you think about it, a bull call debit spread and a bear put debit spread are exactly the same. They just work in opposite directions. So learning a strategy or a directional trade, as opposed to learning the chart and reading which direction the chart's going, I don't think it's a good idea. I think it's better to read the chart, understand the indicators, know the trend strength, so understand how to read trend strength, and then your strategies will work. But if you go, okay, here's only bullish trades, and we now sit in a bearish or neutral market for the next 6 months, how are you going to trade? It's going to be very, very difficult to trade, right? Because your FOMO is going to get you to do a trade that's wrong. And this is the thing I try and encourage people not to do, is that if your strategies in your plan are, neutral to bullish, for example, you have to know how to determine if a chart is neutral to bullish. Like, that's the first thing you've got to do. You can't just take any chart and go, well, I know only the strategy. Let me force the strategy into the chart, because then you'll lose. So chart reading practice, really getting good at understanding candlesticks, levels, directional trends. And we use a lot of indicators that take a lot of that hard work out, because there's a lot of math behind indicators, right? So if you've got effective indicators that have got high win rates, it's much easier to do the trade, whether it's going down or whether it's going up. It doesn't matter. But I think that's the most important skill, is practice reading a chart before you have a bias towards a strategy and a strategy's direction. I mean, I love doing bullish trades. I really enjoy it. However, I make the most money in a trade when it's going to the downside, because downside trading often is faster than upside trading, right? Remember, we take the stairs going up and we take the elevator going down. Now, the challenge is you might make a lot of money in the, on short side trading, right? When it's downward trending, but it's stressful, all right? Because the biggest stress you have is you trading counter to the way in which the market is designed. So the market's designed to go up in price. Companies make more money, stocks go up in price, et cetera, et cetera, et cetera. When you trade against that, it's almost like you are running down the road with a parachute tied behind your back. You're still going fast, your legs are moving, but you're fighting against this big external force, right? The force of the market moving up. So you've got to understand that trend. Yeah, I mean, I enjoy short side trading. It's just stressful.
Does short side trading take a lot more management then?
Yeah, because what you've got to do is you've got to shorten your time frames that you're going to trade on. So where you could do longer term trades on maybe the 4-hour chart, the daily, the weekly kind of thing. With short side trading, particularly when volatility starts to increase, you have to shorten your time frames. 1 hour, maybe the 2-hour chart, maybe the 30-minute chart as well, to trade that volatility to the downside. And you've got to be careful of the reversal. The biggest risk on short side trading is the gap up. It's the bounce and then the sustained movement back to the upside. Because if you've gone short and you're shorting in the hole, bad idea, you're going to get wiped out. So, you have to understand levels. You have to understand your Keltner channels. If you're shorting something that's already at -3 Keltner, not proven to work. So you got to be careful about that sort of stuff. So that's why you shorten the time frames, you've got to manage the positions a little differently. For example, for us, when we go in with maybe a short QQQ trade, right? So QID, let me open up a chart and I will put it on. It's much easier to describe this way. So yeah, this is, let's put in QID, and I'm going to share my chart in a second. Oops, this one, sorry, QID. All right, so where we have the day chart, my apologies, it's taking a little longer because I can't get the screen to work properly. All right, let me get this shared. All right, when you're looking at QID, right, this was a trade that we are in right now. There it is. When you've got a ultra short, so this goes up 2 times, or 2 times the down of the Qs, all right? When you go into a trade like this, your biggest problem is because you've got the leverage in the stock, and this could revert. This is designed to go to 0, all right? This is designed to go to 0. So this is the chart on the left-hand side. What you've got to be careful about is that when it starts to reverse, it's going to reverse a lot faster than if you just shorted QQQ by itself because of the leverage. So here you have to do a trade called a married put, because if I can de-risk the trade, if I can make this trade a 0 risk or a negative risk trade to the downside, so meaning as QQQ falls, I'm going to make money. If QQQ reverses and starts going back up, I don't lose on this trade. I want to make sure that I don't lose on this trade because I'm taking a lot of risk on the reversal. So you use a married put here. You can de-risk this trade. We've got one that's de-risked already to negative risk. All right. So you cannot lose. If the market reverses, you don't lose. Okay. So you've got to be aware of that stuff, because if you're trading to a direction that's counter to the current trend, the almost important thing is, what am I going to lose if I'm wrong? So you've got to go with the married put, right? And you could do the same thing. If you wanted to short the indexes by itself, you use a married call. All right. So we short the shares, we buy a call option to cover us to the reversal on the upside, keep our risk low. That's the smarter way of doing it, rather than trying to just choose a direction without hedging yourself. Okay. So you've got to trade. If you're going to trade short, you've got to make sure that you protect yourself to the reversal, right? Married call, married put. If you're doing a bear call credit spread, for example, you could do a bear call credit spread and add a long call at a longer duration, 1 strike above your short, right? Just a little bit above. So if it does reverse, you've got something there to protect you. All of these things are important, right? And a lot of people don't take into account the downside risk when they trade. What they look at is, oh man, I'm getting a premium of like $5,000. I'm just going to trade this. And then all of a sudden it wipes them out. And they're like, things went wrong. They don't realize they could have prevented that from happening in the first place. So yeah, that's one thing to look at, is making sure that you protect yourself on your short side trades more, because you've got that risk of reversal. So something to think about.
So what about, you mentioned on the under the hood call, if anybody's not seen that, just head on over to Rogue Investing and get on to HoodTalk and sign up for the newsletter, and you'll get invitations for webinars that Chris does weekly. But yesterday he was talking about, or you were talking about earnings, and you want to speak to earnings a little bit? We said that Netflix kind of took a dive after earnings.
Man, I tell you what, earnings trades for me are not the easiest. And the reason is, it's a bit of a gamble, right? You don't really know to what extent the market has priced in particular amounts of information that companies give out pre-earnings, right? So if companies, you saw a couple of months ago, a company like Amazon, when Amazon had that 4 ATR move in the September earnings number, no one could have predicted it, not even the market makers. The market makers were expecting a 1 ATR move. All of a sudden, the stock wiped out a whole lot of people. So I think earnings is a bit of a crapshoot, right? You can win, you could lose. There's safe ways to play it. If you're going to play it, a lot of times, you could sell an iron condor or an iron fly, using the expected move. Unfortunately, what we're seeing now is companies coming out with their earnings numbers and having greater than the expected move impacts on their price. Let's have a look at Netflix. Netflix, man, there was a ton of people buying call options on Netflix the other day, just before earnings. Let's open this up and you can see it in more dramatic detail. There was a lot of people buying over here. They were buying call options here on Netflix for the open, for their earnings. Netflix dropped from 500 down to 400.
It's big.
This is dead. There's no doubt now. When you lose the 200-day moving average, when we got a signal here, buy puts there. Our signal came out on the 11th of Jan to buy puts on Netflix. And this is the thing that people often get wrong about indicators. A lot of people, indicators don't work. Yeah, they do. I mean, here it is. I mean, at the end of the day, if you've got a system that works, use it, right? We got a signal, buy puts on Netflix, bang, money maker, straight up front into earnings. So the thing that you've got to be careful about is it can go either way. And if you make big directional bets one way or the other, and they don't work, you lose, right? So one of the safer ways to play is buy a straddle. All right, so buying a straddle, buy a call and put at the same strike for the same expiration, and one of them's going to work. If you're thinking that there's going to be a greater than the expected move on either side, the call's going to work or the put's going to work, right? One of the two. It's very, very seldom that I see stocks keeping their movement inside the expected move at earnings. It's either amplified one way or the other way, right? So straddles tend to work there.
What delta strike do you usually use for straddle?
Usually you would go at the money, right? So it's got to be around 50 on both sides, but they're expensive trades. So for me, I look at the risk reward and I go, you know what, I'd rather just wait, let the earnings happen and then trade the movement afterwards. You've got to look at your risk rewards more. Like, I don't think trading earnings is easy by any stretch. There are people who play it much better than me. I just find them low probability, right? So if it's a low probability event, you have to go with low cost. And the lowest cost way of doing it is, a call butterfly on one side at the expected move and a put butterfly on the other side at the expected move keeps it cheap. But the whole thing with that is you've got to be careful about when you do it. If you're doing it too early, it's going to cost you money if there's a sell-off pre-earnings. If you do it too late, you might not get the volatility expansion that makes those trades work. So, it's a lot more complex than just saying, oh, well, the earnings are going to go up. Netflix, I look at this and I go, man, they wiped out 3 years in one day. Imagine if you were a long-term holder of Netflix.
I didn't look at the earnings numbers. Were they below the expectations? Or they were?
You know what I think it is? It's just that there's a lot more on the market now. I don't think they're getting the subscriber growth that they had. I look at it. I've got Netflix, Amazon, Roku, Disney, YouTube. You have everything now. How are you going to compete with that? They don't really have that first mover advantage anymore. I look at some of their shows. I hate to admit it, but we're amongst friends. But I like those things like Emily in Paris. I watched that show. My wife convinced me that it was a thing that I should watch. It's hilarious, but that's the only show that I watch now on Netflix. The rest is on Amazon or on Disney.
Mm-hmm.
So yeah, but looking at this, imagine if you were the poor sucker that was buying call options here.
I don't want to imagine that, Chris.
That's it's crazy, man. It's crazy. You got to be really careful. We got Apple earnings this week. If we pull up Apple, so Apple, we've got a put buying signal that we have here, but we have a bullish candle. All right, we've got earnings.
What do you think about Apple? Doesn't this is not a high pressure. You already said that it's a crapshoot. But if you had to take a directional bet, just what would you think?
I have to say the short side, because I'm in a double red volatility band. I'm trending down below the 813. I'm below the 21. I've got volatility increasing, money flows negative, squeezes fired short. Look, this could repair itself. You know, today, if we closed above 167 today, it's a bit of an ask, but if we did, and we closed above yesterday's high, or sorry, not yesterday's high, the high here, so we can get back above the VWAP, this blue line. Man, a straddle could work, but I don't know. I just look at my volatility bands and I go, they're there for a reason, right? They tell you when to get out of a trade. Here's the trade. Bang. Apple, buy puts. If you'd bought puts on my signal on the 18th of Jan, you would have been, you know, raking in the cash. Let's look at Microsoft. I think they are announcing tonight. Here's Microsoft. Double red. Earnings is tonight. Yeah, after the market closes tonight. Big bullish candle here. We have a reversal here. Next signal on the trend oscillator is going to be a green arrow. We don't have a squeeze. We're bearish. Volatility is increasing. Microsoft traditionally rallies into earnings. This is the first time I've seen in a long while that Microsoft hasn't. So, you know, if we go back to the last earnings, you know, here was the rally into earnings, here was earnings, and then it moved up, right? But look at the difference. We had a green volatility band back here. We have a red volatility band over here. Do you want to go against the volatility bands? You know, they keep you safe. I don't know. This is a tough one. I would probably say movement to the short side, and it's disappointing that Microsoft's timing is pre-Fed, because these are the guys that are going to suffer the most from interest rate rises. So, you know, they might come out and say, you know what, guys, our numbers are going to be crap for the next 3 years while the Fed gets their act together, you know, and this could just sell off even more. You know, I wouldn't mind taking a lottery bet on a put, you know, just buying a 30 delta out of the money put for the next, you know, 20 days and playing the earnings announcement and buying maybe a 30 delta call 14 days from now and possibly playing that to the upside. You know, maybe we get a bounce up and then a sell-off. It's hard to tell, but the volatility band should give you a clue as to where to trade. And obviously these signals, you know, when we've got these signals, they work. You know, here, if you'd sold puts, if you'd bought puts up here, you would have made money. If you take your profits there and then you do another one down here, buy calls here, sell them there. It's the system that we have is very robust in terms of, you know, just follow the signals. It doesn't require a lot of work for people to make this work for them. What stops people from doing this is they question it. And what I've found is as soon as you apply a sort of intellectual overlay as to what a system is telling you, it's your ego getting in the way. You know, if you don't trust the system, the whole idea of a system is you've got to play the signals. I can't look at the signal here where it says buy calls and say, oh, no. You know, you can't. It's telling you to buy calls. And 3 days later, you're looking at this and it's got a reversal signal here and you go, shit, I should have bought it down here when I was told to buy it. And then you still question it. And then it comes up and it says, sell those calls now that you bought there. You make a profit. And you go, oh, I'm going to buy more because now we're in a double green and we're trending up, but you don't see this candle here, which is a divergent high, which is telling us price will go down. And then you don't see this signal here, which is a trend oscillator sell, which tells us price will go down. So you buy your calls here because you doubted everything on the way up. And now you lose. You lost this opportunity. You've lost over here. No, you got to stick with it. You know, that's how I built this, was to make sure that you don't question. Because the biggest problem people have is questioning themselves. So, you know, this is the way to do it. But, you know, you can't stop people from, you know, jumping in front of trains. So, you know.
No, you can't.
No.
What about the commodities? I'm kind of curious where you think commodities are going.
Well, the two that I'm watching and we've got positions in are energy, which is clearly double green. We've got a strong signal down here. That signal, you know, historically 56% win rate. Amplitude of the move is okay. It's not the best amplitude. I closed my put spread that I had here on energy yesterday because we broke the trend line. we are slightly below the 21. We're still in a double green environment. Money flows flowing in. Squeeze is losing a little bit of upward momentum. We've got a downward price signal here. Next signal will be a green arrow. Volatility is increasing. So I like the trend here. All right, if energy drops down here below the 55 down there, sorry, that's the 21, that's the 8. If it drops below the 21, then, you know, we have to consider the trend broken and we have to get out. But for now, energy remains one of the strongest sectors. The other one is corn. So corn is one of my favorite inflation plays. Had a little bit of choppy action here. We got a buy put signal that quickly reversed here, where we got the buy call signal on the futures. Green arrow for the trend, moving up, squeeze firing to the upside, V-score going into the green, money flow going in, volatility coming down, top end of the range, so slightly overbought, but, you know, definitely something worth doing. Now, we don't get historical performance numbers for our signals here on futures. If we look here on the ETF side, same signal, right? 4 candles back, 1, 2, 3, 4. Here's the signal on the futures. Here's the signal that we get on the ETF. You can see the band starting to change. So we went from a green red into a double green on the back of a blue candle, which is a green arrow, squeeze firing long with compression, mid-level squeeze, money flowing in, going into the overbought side. So a lot of people use this overbought, oversold, and they go, oh, it's overbought, I can't buy it. And there's nothing bullish, or sorry, there's nothing bearish about being overbought. Be very, very careful about making the assumption that because something sits up here, you can't buy it. A stock can maintain its degree of overbought for a long period of time. And that you can land up missing opportunities that way. So from here, we've moved from green red into double green on a strong signal, 60% win rate with a much bigger amplitude. All right. And this average duration is around 43 days. So you don't really want to be out of this trade. So you've got to go longer than your average duration with your calls, maybe a call debit spread, long dated at the money, 60-30. You could do a 30 delta call at the expected move 90 days from now and just play the trend. So corn is very attractive. And when you look at the whole market relative, right? So this is the whole market relative. You just see the sea of red, all right? This is the column for below the 200, all right? Everything pretty much is below the 200. You do not want to trade bullishly when something is below the 200. You need the 200 to be restored. And once it's restored, you need to start looking for squeezes. And when you start getting those squeezes, you need to start seeing the moving averages giving you permission to enter a trade. Right now, the only ones that are giving you anything are the FANG short. So this is the FANG short shares. So going short Microsoft, Twitter, Apple, etc. And you've got a short trade on the small caps. So the TZA is also bullish. Although we haven't got the 34, sorry, we haven't got the weekly 21 here. All right, we need the weekly 21 here. So not much positivity really in terms of the bullish trade. So you've just got to trade conservatively, you know, look for the areas of relative strength and focus there. You know, don't start venturing in and trying to pick a bottom on any of these things that are red, because that red can just continue. You know, that's the hard part.
So like, what do you, where do you see the market like in a week? I mean, if you had to, so I mean, like if you had to get like a, you know,
I would say, so here's my bet, and it's going to be a pretty broad-based bet. I think it will be somewhere between 200 and 9 million. So, you know, it's so difficult to tell because you've got so many external forces at play. You can't just make a bet and say, well, we're not going to be higher than here. You know, you've got these tensions in Russia. You've got, you know, you've got all sorts of things that are outside of the market's control. You've got the Fed, you know, Jerome could say something tomorrow, which then suddenly says to the bulls, you know what, open your checkbooks. You know, we're not going to raise rates. We're going to keep doing what we're doing because this sell-off was just wrong. You know, who knows? I mean, you know, that could trigger an atomic explosion with the bulls, and all of a sudden we're at, you know, new all-time highs by next Friday. It could also be the opposite, right? We could have the transformational Omicron version 28 or whatever it is, call it what you like, and the market could be down at zero.
So in the absence of an external event, I mean, this is obviously whatever, you've already qualified it by saying that no one honestly knows, but I mean, just if you had to make a guess, like where would you
Look, I hate being, I'm put on the spot here because I would probably say a week is too long, right? I could probably give you an idea of today, maybe tomorrow.
Well, no one's holding you to this, Chris.
Okay, let's see. Okay, all right, let's have a look. So let me explain my thinking.
Okay, yeah, do that.
Because I think this is where it all comes down, right? So here we have the 45-minute chart on the SPY. We've broken above the trend line on a bullish candle over here. We had a divergent low. We crossed above the trend line. We're heading towards our 34 EMA on the 45. We're starting to form a double green. Okay, we're starting to form a green. We have a trend oscillator pointing to the upside. We're lowering. We've lost downward momentum. So we're starting to move to the upside. Our V score on price is looking bullish. And money flow is coming back in, right? Or nearly back in, right? Volatility coming down. A couple of bullish things that sit here on the 45-minute chart. If we look up at the top, you can see this really extreme selling that we've been seeing over the last couple of days, right? So we know that the selling, when it gets to this level, we really need to see buyers coming back. Okay, so I can't be bullish until we have a lot more green than we have red. And right now we have way too much red here and not enough green. Now we look at the put call ratio and we go, you know what, look at how extreme we're at here. This sort of level of pessimism and sentiment hasn't been seen since the December sell-off at the beginning of the month. The last time we saw anything similar to this was back here in July of last year. And it wasn't a long duration, right? It was literally a week we went through this, and this sort of rally back down was very powerful, right? So that's what happens when the put call ratio gets to these extreme levels. There's COVID, right? There's COVID. We all know what happened between March and July. That bounce that we saw in COVID was phenomenal, all right? So you really want to be trading the movement of the put call ratio down from extreme highs down. And what we're looking for is this little black dot to reach a sort of turning point. We're looking for it to turn. Once it starts to turn and this starts coming down, then we trade to the long side. Volatility, there's a standard rule, 2 closes on the day chart above the second Bollinger often results in volatility being pulled back to the mean. So if we get the put call ratio coming back down, we get volatility coming back down, and we get ticks going up, we may have something. Okay, we may have something. Bit of juice there, right? But we also need squeezes to form, and we also need momentum to start to change. So we're looking for color shifts in our bars, right? We're looking for red candles to go green. Once red candles go green, and we have positive momentum now moving to the upside, and all of these factors are starting to come into play. Phenomenal, right? What we did get yesterday, and this is something that I use fairly regularly, is I use the put call ratio over a 45-minute chart, and I apply one of my option triggers. All right, so one of my option trigger signals, I apply on the put call ratio. It's very different. A lot of people don't do this. But from here, we got a signal to buy calls. All right, on the 20th of January, we got a signal to buy puts. This is only for long only, right? This is not for selling anything. This is long only. So buy puts came out on the 20th of Jan. I've now got on the 25th, I've got to buy calls, right? So I'm very long on the SPY in the short term. Okay, I use this signal to dictate trend, all right, and to dictate direction, right? So if this is telling me to buy calls, I know the market's going to go up. So I know the market's going to go up. I just don't know over what time frame it's going to go up, because I could get a reversal signal pretty quickly on this to buy puts, right? I could get that fairly fast. I think we're going to find a little bit of resistance as we start getting up to these upper layers, these gray areas here, the 451, 459, those are going to be tough to break. All right, this is where we have levels of untested demand. So we need to know that we can get through there. So what I'm looking for is this trend line to hold. I'm looking for this 433, 434 level, this green level to hold as support. If we can hold off here and we can get squeezes to form, we could see 450, 455. We could probably be up here within the next week to 10 days. That's my thought. But then we need a lot of things to go right. I need Jerome not to say anything bad. I need the Russia thing to calm down. I need those Houthi guys in Abu Dhabi to stop sending rockets. You know, we need all of that to sort of, you know, calm down. And we need good earnings numbers.
I'm going to call my people right now and make stuff happen.
You call your folks, man. So when you start looking at directional plays, one thing I do suggest to people is just ignore the news. All right, ignore the news. Focus on the indicators. Focus on the things that are going to drive behavior and sentiment and the psychology of the market. It's not going to be based on CNBC. All right, there are people I know that trade everything against Kramer. So if Kramer says go buy, they go short. You know, I know people who do that. You know, there's a fund now that's come out that just shorts everything that the ARK, you know, Kathy Wood buys. They just short the whole thing. It's quite funny to watch. But just avoid that stuff. Don't get involved in those things. You don't control it. So if you're going to let your emotions run away with you, you know, it can lead to bad decisions. So indicators, they work. Use the right ones. Find the ones that work for you. Are mine better than others? I don't know. I just know what works for me. And, you know, if it works for me, it works. It's not, you know, I'm not here to say that someone else's strategy that works is wrong, because that's wrong. You know, there are many ways to win this game. You've just got to find the way that works for you. So yeah, I think the market will go up over the next. You know what? I remember hearing one guy get asked once the same question: where do you think the market will end? And he said, somewhere over here to the right of the screen. So yeah, if you want to know where the market will be at the end of today, it will be somewhere over here, somewhere on this line.
That's a very political answer.
Well, the thing is, no one really wants to get into the art of prediction, right? I'm an economist by trade, and one thing that economists can do is give you a statement and be right both ways. You know, I've never met an economist that's wrong. You know, they always say, well, it could be up, it could be down. Okay. And then when it's down, oh, you see, I told you. I try not to get into the art of prediction, because predicting anything just sets you up for complete failure. So just don't get involved. Like, if someone tells you the market's going there, they have no idea. You know, it's not worth putting any mental effort in the art of prediction. You know, maybe when Mercury's in retrograde and Venus is doing this and Saturn does that, who cares? No one cares.
You
no one
have
knows.
astrology in your trading signals. That's important.
Oh yeah, just don't try and, you know, second guess things. Just follow the signals, man. There's an easy way to do this and a hard way to do it. If you want to spend 20 years going through the same learning curve as people before you that cost them money, like me, it cost me money, man. 20 years ago, I wasn't trading effectively. And a lot of people ignore that experience. You know, they don't want to do it. They just try on their own. They keep losing. You know, at the end of the day, you're not going to stop people from doing silly things.
No. So, hey guys, head on over to Rogue Investing /alpha. Check out Chris's products, webinars, all that stuff. So appreciate the info, Chris.
Awesome, man. Have a good day.
Yeah, you too.
All right, we'll see you soon.
All right. Bye.
Take care, guys.